And one financial statements. And this is part of my series to discuss all of the different financial companies because I know so many of you guys bank with different companies. You're trying to figure out, is it safe? Is it not safe? How should I think about it? And then a lot of folks forget that it's not just the regional banks that are impacted by all this, it's also the consumer finance companies as well. Now, Capital One is a little bit of a special animal. I would say that to understand the credit card companies, it's even harder than understanding regular regional finance companies because there's a couple of extra layers. So what I want to do is kind of decode some of that for everyone, and hopefully that will help y'all out. All right, past performance is not indicative of future returns. I have no skin in the game as relates to Capital One. I am definitely watching it because the nature of Capital One is something special. They do tend to be a bit more, I don't want them to get mad at me later as a company, but they do tend to be a little bit more aggressive and a little bit lower credit quality than, it'll show up in Capital One fairly quickly as you start to move through the economy, any kind of weakness that's happening. And so I always look at the consumer finance companies to understand what's the pulse of that and what's being done to reserve against any of those types of issues. So let's kind of go through it a bit. But yeah, I have no skin in this game other than to just catalog this for anyone who's trying to figure out if they have an issue with Capital One. In short, I would say the answer is not really. And here are the things that you'd want to look for. Additionally, if you're looking for investment, I still think personally, you do you, but I do think you might want to pause just for a second. That's kind of how, if I was to one-liner it, now let's go through it. Okay. Make sure I go to the right first stop. Okay, so the thing with Capital One and any credit card company that makes them a little different is that you're going to see a much larger provision for credit losses. Okay. And so I don't want you to freak out if you're comparing Capital One, American Express to a lesser extent because of the nature of their business, or Discover, and you see this significantly larger reserve for credit losses, and you're like, WTF, right? Because just the nature of their business is very different. Not to mention the history of their business is very different. So when you go through the income statement, the shining weird thing you'll see is this $2.1 billion increase in credit loss reserves year over year. And you'll see that even over the quarter, that's a huge chunk up, realizing that that's been an incredible drag on earnings for the entirety of the year, as it should. Okay, I don't know another way to say it. As it should be, because we're coming off of 2 years of incredibly low credit losses driven by helicopter money, Fed spending, really high employment, and inflation, which is still kind of dancing its way through the system. Capital One spoke about this a lot. And as far as the way that they're modeling it and thinking about it, they are thinking that inflation has kind of two modes of transmission into potential for credit losses. The first mode is actual inflation, as relates to what it does to your funding sources, what it does to this, what it does to that. The second way really has to do with the fact that you got paid a little bit more, but it didn't necessarily compensate for how much you now have to spend. And so they mentioned that hasn't happened this way in like 40 years, so it's kind of hard to model it. I love their honesty because everybody's suggesting otherwise is full of as chocolate ice cream emoji. Okay, so when we look at this, the things that I would just shout out is this provision for credit losses is huge. And then we definitely will investigate how do we feel about that, because that's very important. Operating expenses also increase. So I'll show you what the nature of that operating expense increase, but keep in mind, depending on how you feel about the 2.1 billion buffer, it may not be as bad as this earnings drop of 62% looks. Okay. We're still not taking L's. We're still taking W's. So, you just have to realize the fluctuation of different businesses in different cycles. Okay, let's look at the loss reserves, which were significantly higher. And you can see from the third quarter of last year, which I talk about in more than one video, because some different financial institutions didn't want to acknowledge that this is true. This is 100% true. Okay. Since last year, you've seen increased loss reserves. Guess what the other thing means that you're seeing? You're seeing a pullback of credit best a person can, best a bank can. Okay. And so it shows up here clear as day as well. And that's, you see that they increased it starting after an all-time let's huge reserve during 2020. There was a massive release that drove most of the credit stocks up, and now we're kind of coming back to that. What I also want you to kind of look at on this particular slide is the fact that, as relates to cards, we're really getting very close to the same loss ratio reserve that we had in 2020. That gives you a sense for how much management is being conservative. Okay, because yeah, the portfolio has grown. At a minimum, you can just use inflation as your metric for how much it should have grown, 8%. But boy, are they worried about credit losses. That's going to be important because I'm going to show you where it shows up in different parts of the balance sheet. Okay. Also on this slide, shown very clearly, is the mix of the credit losses. Most of Capital One, by and large, they are not making money off of any rando type of lending. They're making money off of credit card lending. Okay. That is the biggest source of revenue. And then it's the margin over that revenue that allows them to do well. That's what net interest margin is all about. And then there is the reserve for credit losses. Okay. Because the margin on your credit card statement, y'all know it, your APR is crazy, right? We all know that. Okay. So because the APR is crazy, there is buffer in there to take bigger loan reserves. Okay. It's a loss reserves. It's also called loss coverage ratio, allowances for credit losses. These are all the same word. It's basically the buffer they're taking to make sure that if you fail to pay your bills, they're not, in a pile of poo, for lack of a better way to describe it. That's what that is. Now, off of the main part, the credit card part, you're going to obviously take ever so slightly higher than parts of the bank that are lending and they get to repossess something of yours, namely your car, your house, that sort of thing. Or if it's on the commercial side, they're taken in a whole mall or something. Okay. So that's how I want you guys, when you're reading this and trying to do this for yourself, make your own opinion, to understand the nature of the numbers, the feel of the numbers. Okay. Let's talk about net interest expense, which I showed you was up still a lot, up 11%. What was that? And this is clearly disclosed. They paid people more. Okay. Year over year, incomes have increased. They paid people about, most of the increase was coming from paying people. So you can kind of see overall the increase was 11%, but the most you can see the biggest chunk of that was employment. So that's like a 20% increase in salaries and benefits. Remember, benefits is a real thing too, because that's part, insurance is in that, stuff like that is in that. So we can't get too crazy. It looks like they were a little bit better than inflation to try to keep good employees there. But I get it. Some of you guys have strong feelings on this kind of thing at a bank. So that is what it is there. Some of it, though, as you can see, did come out of professional services. So that's taken someone from part-time, making them full-time. Okay. Now, not enough of it came out of that. So really it is kind of paying people more to keep up with inflation, and then also probably to promote certain individuals, that sort of thing. So that's how we look at that. You can see that what they didn't spend on and what some of the money came back to them on was marketing expense. And that was something that they spoke to in the call. They're not trying to get people to take credit cards out aggressively right now because they're like, yo, we're reserving a lot more. So we don't necessarily need people, we're just fine given what inflation has done to just see how it goes and make sure that we're provisioned adequately for the losses that we typically see once you have credit quality and credit behavior go back to a normalized period, and also, which they discussed on the call, potentially overshoot a little, because it just turns out when everybody's doing great, there's a set of people that are going to overshoot it and spend more money than they have the ability to make consistently, and that's what plays out in the credit world. Hence, that's why the APR is so much higher at a given moment. All right, now let's look at funding. Okay, funding is going to be your balance sheet every day of the week. And let me go back to balance sheet. Here's the balance sheet. This is what makes it so hard to read the financials when you're kind of still getting your feet underneath you to how to read this. And for banks, it's because the assets look like liabilities and the liabilities look like assets relative to normal stuff. So we're going to break it down. everything in your liabilities can also be called cost of funding. All right. So we're just going to call it that's your funding cost. Okay. And everything in the assets is the investments the bank made to try to get some kind of spread on it, some kind of like return on their capital. Some of that so now you might be like, but I don't get it. How does me spending on my credit card end up looking on the assets? That's going to look primarily for these guys as securitized assets. So what they do is you and all the friends in your neighborhood that have approximately the same livelihood as you, same FICO score, they're going to take all of that and stick it together so that they get a net loss ratio, a typical loss ratio that they'd expect to see from you and all your friends. And then they sell that basket out, and that's what the securitization actually is. One day I'll do a proper video to help y'all out to see it clearly. But that's where it shows up. Just like everybody else, though, there's just regular cash too. And you can see the nature of their cash. Some of their cash they put in other banks, or it's interest-bearing deposits, other short-term deposits. So you can see it. 46 billion is what they have in cash against all the other liabilities that they have. Okay. We always look these days at deposit funding because right now that's the issue. A run on bank can be very, very painful for anyone that's structured like a bank, of which the credit card companies are, in fact, three of them is structured. Well, other than unlike Visa and MasterCard, which is not a traditional credit card company. I will have to do those separately so you guys can really see and understand it. But like Discover, American Express, and then all the bigger banks, those are all structured like a bank. Capital One is structured like a bank. Okay, period. So I've been trying to get people to use a number that is now fairly commonly I can see used among finance professionals that work in bigger banks. Okay, not your average private wealth guy. I'm based in New York, even though I'm hanging out in Sedona right now. You can see Bell Rock right behind me, but they are using CAPM as their major metric, and that is cash as a percentage of deposits. So I'm telling you that the cash as a percentage of deposits right now is the opposite. So 46 divided by 349. So you can kind of see 74, that I don't know why I didn't do the math for you, but that's what you're looking at. It's about 13%. Sorry, 13% cash as a percentage of deposits. This number, sorry, I should have just made it bigger. Cash as a percentage of 13% versus 8.5%, which is what they were last year. So they are absolutely raising cash as a just in case situation. Now, because of the nature of this bank, they don't have to hold 10% like some of the bigger banks do. So they're well over what would be required. It's just, how do y'all feel about that on a given day? I don't know, because no one holds 100% cash on deposits. That is what it is. All right, now let's look at the other stuff besides cash. The one thing I wanted to note is that securities available for sale, that's down year over year, but that's up significantly from the previous quarter. That's something we're going to watch like a hawk going through the next 2 quarters, because that essentially turns very easily into not securities available for sale, but securities held to maturity. That essentially is this: securities available sale is all the loans they're making, including you using your credit card. And then you swipe your credit card and they sell that right on out. Okay. So one of two things can always get these companies in trouble. But right now I don't see any kind of issue. Okay. Right this minute, 2023, only good for this minute, because we're gonna have to watch it quarter by quarter. Right this minute, they seem to understand that that's a problem and they're doing a set of activities. But you can see that increase still quarter over quarter and is up, but is down year over year. That is basically every time you swipe your card, they stick it in this pot of money and then what have you. Now, things that you can look for as the common person is you can look for banks calling up people saying, oh, I'm going to decrease the amount of your credit limit, or they're going to be proactively trying to decrease something as relates to your credit cards. That's what you're going to look for, because that's what it ends up looking like when they get very serious about it. Okay. Right now, it seems like it's all right the way that it is. Now, we're going to map that down here to securitized debt obligations. And you can see that that's up a lot year over year. And I did the math for you. So deposits are up year over year. Securitizations are up year over year as the method of funding. Okay. So we're going to watch for that and make sure that those securitizations still continue to leave the balance sheet. Right this minute, the number's not so crazy that I feel intense about it, but it is something to watch for. I especially don't feel intense about it because they did, in fact, increase the total deposits up 12%, which means that people aren't pulling money from this bank. Okay. But, you know, there it is. Now, the cost of capital on the securitizations, you can also do that very easily. You can just assume that this interest payable is partially some of that and just do that division for yourself and you end up with, there you go. So I estimate it's approximately like 3.4% is what they're doing. But remember, you got a huge chunk between what their cost of capital is and your APR on your credit card. That's why it's ever so slightly nicer to be in a credit card company right this minute, only because this is a big only, okay? Only because we still haven't had credit losses. What we've had is run on banks, okay? So it's a very funky, strange thing going on there. I will, Corey, I'm going to address some of your stuff at the very end. So thank you guys for reminding me to go ahead and stick your questions in the comments, because I do try to go through them and then hopefully YouTube passes them through, but I noticed some of them don't. So if I didn't ask your questions, because YouTube's not passing them through to my fancy software. Okay. So, 28, let's see, what else do I want to show you? Okay, so I'm gonna go through some of the other slides because there's no one's hiding anything in these bank quarterly reports. Now, do I think that they could present them a bit more in the style of the layman? Yeah. In fairness, the layman never used to listen to or review the quarter, but I think we're all getting a lot smarter about our investments. So, that is what it is, but it's not for lack of disclosure. And so it's really the jargon, I think, that still trips people up. So that is the balance sheet, but they break out every piece of it. So funding sources, here was a great little piece that was in the quarterly report, the 10Q, and you can see 71% deposits are now 73% of the total funding mix, 398 versus 471. So it's a couple things there. Don't worry about that too much, but it's approximately, this is the mix of it. All right. There's like 20 million, 28 million more that to be accounted for, but we'll talk about that in a second. But this is the funding mix. And you can kind of see exactly what I was saying. Securitizations are still showing 4%, but they are up a lot from the previous year. Oh, sorry. I'm saying this wrong. This is the previous quarter. So securitizations are up a lot over the previous year, but not over the previous quarter. And we can see that deposits are more or less the same. So the funding mix quarter over quarter hasn't changed, but consumer deposits has changed. So the mix has switched a bit there. So that's what we're seeing. Yeah. Okay. So you can kind of see it there. All right, cool. Now loan mix, I want to show you this. They do provide this. The loan mix, you can see credit cards. They can't do nothing about that. Okay. They've already issued the credit cards. All they can do is try to tighten the credit by calling you up and saying, hey, by the way, instead of 35,000 limit, $100,000 limit, whatever it is, some of y'all are baller, $800 million limit, whatever it is you have in your credit card, they can squash that down to $500,000 or squash it down. It's been done before in 2008. It was done for a number of people. So realize that that is absolutely something that can happen, and we watch for as like anecdotal. But you can see here, from the previous quarter, they are trying to decrease the consumer banking and commercial banking pieces, but both of those are up year over year. Otherwise, the numbers wouldn't make any sense. You can take a look. Okay, so this is a big change because before Silicon Valley Bank got right, they actually were becoming ever so slightly more aggressive because they just weren't seeing the credit losses. But clearly, they changed their tune in the last month of the quarter, since because the quarter came out market timestamp in December. They come out and talk about it almost to February. And then from February to now, they were like, you know what, we're going to dial back some of that more aggressive stance and get really conservative on the quarter. And that's what happened. So I'm stoked for that because I was a little bit worried about them. So here's what it is. Now, both the notional and percent reduction in consumer debt. So let me just move this on up so you can see this better. That did not help. Sorry, guys. Let me do it this way then. Keep my little face on there. All right, now you can see it a little better. If you look here, you'll see that you'll see what they're trying to reduce on the quarter precisely. And that's a really great sign from quarter over quarter that they're trying to reduce it. It tells you that they're starting to wind it down. Now, other places for those of you who are looking broadly at financials that you can think about this is that this reflects the desire to just not have so many loans, period. This is I'm going to call it a synthetic credit tightening, because usually a credit tightening is when you start to have loans explode on you and so people don't lend. It looks like the banks are preemptively doing it regardless, mostly because they're worried about their leverage ratio themselves as companies. And also, they don't want to be caught strange if the market just decides that all the depositors are going to walk out the door. So we're already starting to see it here, despite the fact that we're still not seeing any kind of meaningful credit losses. Okay. Let's see other stuff that I had for you guys. Funding source. Let me just stop the share for a second and do a quick double check. Oh yeah. This is the reserve ratios that they're showing. I just want to show this. So they do have a pretty decent amount in reserves. They come in at a CET capital ratio at about 12.5%, which is an improvement, over the previous year for sure. But it just gives you a sense that they are trying to be conservative. And if it works out, all that stuff gets released and you end up with this phenomenal quarter. If it doesn't work out, well, it's a good thing they started reserving for it. It's really how it is. And let me see if there's anything else I wanted to show you guys on this. Yes. Okay. Yeah. And I just want to reiterate this one thing for you, which is the size of the reserves that are happening. Okay. Because I think sometimes this is not obvious. Okay, so just in the domestic card business, they're relative to last year, they're going to go ahead and reserve 1.62 billion. And that was already, if you look really closely at this line, you can see last year they were taking smaller reserves, but this is not the total reserve. The total reserve is still this number over here. Okay, they just keep upping it very aggressively. Now, that, if it again reverses itself, can be a really wonderful thing. But again, between then and now, we have to have no more attacks on banks, and we have to not accidentally collapse this economy to the point where people really start failing to pay their bills. Okay, so that is all I have prepared. Seems like the banking sector is still pretty unstable. I think that's right. Is there, it's funny because I just finished listening to the Berkshire Hathaway meeting, and I am going to do something on Berkshire, as well as a couple of you have put banks in the comments after this video. If I don't get it and it's not obvious, make sure that I do see it, because I do plan on doing as many banks as possible, since I think more than caring about your stock portfolio, you care whether or not your money's safe. So that's why I'll just do. I would say it was interesting, because Warren tended to suggest that the banking sector is stable, but for a few banks that are doing something. I'm not convinced that the but for is correct as far as that goes. I think all of them moved in one direction as relates to held to maturity, made money off of it in various ways. And then some of them provisioned for credit losses. Some of them hedged at a level of about 200 basis point move, 100, so they were like, oh, we're making enough. If interest rates are up 100% or 1%, that would be the normal scenario. So let's just reserve for 2%. Lo and behold, we're at 2.5%. So I think some of that is coming through. And I think that because when I look at what JP Morgan bought First Republic's book for, given that it's jumbo loans and the duration number that was quoted would only suggest around 4%, it suggests that they did at least a partial hedge. That's what I'm looking at. Now, I could be wrong, and we'll never know. If you know, though, put it in the notes. But given the number that is implied by the discount that they took immediately, that's the issue that I have. So my suspicion is that's what's actually going on, and as a result, it's a little bit of a struggle. I peed on Kenny's pool. You crack me up every time I say your name. I'm not sure what you mean by WY, unless you mean Ticker Weyerhaeuser, but just confirm with me. I did actually listen to Weyerhaeuser. It's an important one because it tells you what's going on in the lumber market, as well as the land for sale market because they own a composite of the two. That land, you put trees on it, you sell the trees. Additionally, there's a couple different ways that you can do it, or it's just land and then you sell off the land because land's worth more. That's the lumber business in a nutshell. It's not the Grand Yeah, it does. We're very close to the Grand Canyon here. This is my best friend's place. She is so sweet and has like an annual kind of hopefully it'll move to more than annual because I do love her home in Sedona, but I'm in Sedona, Arizona, one of my absolute favorite parts of the United States, which is, I'm a travel person. The United States to me is one of the most beautiful countries on the earth, and I don't think people realize it. But this is Sedona. This is Bell Rock right behind us. Bell Rock is beautiful mountain. Well, I call it a mountain, but other people are like, May, you got to get less afraid of heights. So that's really what it is. All right, let's see what else we got. Pac West. Let me just do a quick, Corey, I'm not going to know. There's not too much different that's going on in Pac West. It's really the same kind of situation. We're all watching. It's like you got a family member that's at the hospital or something. It could go either way. Do you know what I mean? It really could go either way. You don't, I mean, they didn't lose as much as First Republic in deposits. Nonetheless, they got some of the same issues as does Western Alliance. That's why I definitely did those videos for folks so they could make their own determination of how they felt one way or the other. Let's see, we got anything else? Some of you guys, DL Saint, just a quick shout out. Appreciate you. And I think I might be doing a podcast with him fairly soon, but I'll post details because he's sweet enough to have me on his show. And that's all I've got for today. Definitely let me know what you care about because that's what's going to drive it, since I care more to help people out with figuring out if they like their bank that may be a public company. If it's not a public company, it's going to be harder for me to do the work on it. And good luck with your investments and stay safe with your money.